We've just heard Trump. People, they're getting a little bit yippy, a little bit afraid. How should Australians think about risk in their super given all this global uncertainty?
Oh, look, I think this is the kind of environment. I suppose the key messages we're trying to get across to members is that, any long-term investment journey, and super is the longest-term investment journey any of us are ever going to have, this kind of periods of volatility, whether they're triggered by economic events or geopolitical events or trade events or whatever, they are part and parcel of any long-term journey. And so this sort of volatility is inevitable. Certainly the period we're going through now, as far as trade and tariffs and what Trump is doing, is pretty extreme and pretty extraordinary. But I suppose the main message we try to get across is, look, every period of uncertainty, every period of volatility does come to an end. At some point, life and business and the economy moves on and the markets move on. We can't try and predict in advance exactly how these events are going to evolve. We can't manage money that way. What we can do is try and take advantage of market volatility when it does arise, and certainly there's been plenty of opportunity to take advantage of this volatility in the last little while, but also to make sure we're building portfolios that are very much focused on delivering the returns members need for the longer term. That's really our prime focus.
So, as I said, I want this to be a high-level education episode because whether it is craziness coming out of the White House, a pandemic, a global financial crisis, what was before that, .com boom, these are things that create uncertainty.
Absolutely. And look, the world is always an inherently uncertain place. I mean, you can't hope to reliably forecast how these things are going to evolve. And I think that's another key message we try and get across. We often get asked by members, well, why didn't you see this coming? It's like, well...
And they're legitimate questions, aren't they?
They're fair questions. Yeah. And when you look at the way the world evolves, it's impossible to forecast these things in advance. Especially short-term economic and market forecasting is, on a good day, it's a mug's game. And one of the dangerous things is that even if you do make a really good short-term forecast and you decide to move a portfolio one way and it actually works, now how much of that was genuine skill and how much of it was dumb luck? Who knows? We just don't think we can reliably generate returns that way. We're far better positioned if we just focus on the longer term, manage risk on behalf of our members, deliver the kind of long-term returns that our members need, and take advantage of these sort of volatility events. Because one of the phrases we've used on a recent podcast is this idea that, look, the share market has been on sale, that you've been actually able to buy quality companies at beaten down prices. We've not been panicking, we've not been selling, we've been buying. Yeah. And certainly, as of today's date, we've benefited from that buying. But this doesn't mean we're out of the woods. I think we're in for more global uncertainty, more geopolitical uncertainty and trade uncertainty for some time. Look, eventually markets do move on and we will see a genuine recovery, but I just think the short term is going to remain pretty volatile.
And when we think about it, we don't want to invest in growth assets or, from maybe a balanced super portfolio, a growth or a high growth for a period of less than 5 to 10 to 12 years. Now, I'm going out on a limb to say, hey, kids, the next 4 years will be uncertain, particularly in this window of craziness. Because we've seen a guy in the White House basically have the world as the kitten and he's got the dangly ball. And he's just showing everyone he's got the power. Yeah, it's all wild. So having said all that, I just talked about growth assets. Are defensive assets becoming more important as, because what's going to happen? The markets are saying interest rates will shift. So talk to us about defensive assets in portfolios.
There's several things. Firstly, the traditional defensive assets. So these are things like cash, term deposits, government bonds, Australian and international bonds. I mean, generally speaking, in a portfolio, these assets are meant to provide you with a reliable income, but also capital protection. And generally speaking, when you go through these really challenging events in share markets, that's when your defensive assets kick in and provide you some protection. And you've seen some of that recently. And so it's a reminder that as part of a diversified investment strategy, you need to have some defence built into your portfolio. How much defence depends on how much risk you're prepared to take, what stage of life you're at, how much volatility you're prepared to accept. But generally speaking, you want to have at least some defensive characteristics in a portfolio. The good news out of the last few years, because you've seen interest rates rise, because you've seen the yield available on government bonds rise, and that's become about because bond prices have fallen. Now, actually, defensive assets look more attractive than they did. Because you recall coming out of COVID, when we saw cash rates in Australia cut to close to zero, you saw interest rates internationally fall to ridiculously low levels. It meant that, if I was getting very, very low returns on my cash and defensive assets. Now, I can actually get a reasonable return by allocating a portion of my portfolio to these defensive assets. And in this kind of environment, it's a reminder that sometimes having that defensive exposure is useful. It's all about diversification, lots of eggs in lots of different baskets.
And I guess with the ordinary course of portfolios, portfolios will have a target that we want a band, a percentage band. There'll be this percent in Australian equities. It might be 25 to 35 at any one time.
Yeah.
Does your team, when you manage portfolios, given that the product disclosure statement or the rules that you say that we run the portfolio by, would your team hold off a rebalance if it is so uncertain at the moment and just wait 10 minutes? Like, what are you guys doing there?
Generally speaking, there's probably two aspects to this.
Yeah.
One is we're rebalancing portfolios very regularly.
Yeah.
So generally speaking, we take advantage of there should be some what we call a rebalancing premium. If you're rebalancing the portfolio regularly, it means you kind of get an opportunity to buy low and sell high on a regular basis. So we do rebalance the portfolio, but the other thing we do is take advantage of market volatility through what we call dynamic asset allocation.
Yes.
And so, for example, going into this most recent period of volatility, we were basically positioned a little bit defensively. We were a little bit underweight shares and a bit overweight bonds. And then you saw shares sell off dramatically and bonds performed really, really well. So we unwound that. We did some buying. Now, that's proven to be quite profitable. So we do take advantage of that market volatility when it arises. We're not trying to hit every ball for six.
No.
Primarily what we're trying to do is two things. One is make sure that we're delivering what's on the box. If we tell our members we're aiming for an average return over the next decade of X, we've got to hit X and preferably beat it. But what we're also doing is try to add a bit of incremental value around the edges. And these sort of volatile times kind of give us the opportunity to do that.
Yeah, well, there you go.